I will now introduce Anastasia and Ronen. They are both professors at City University. Anastasia now I get Nesvetailova. How would I do on that? He's the director of the City Political Economy Research Centre and author of numerous academic media articles on financial crisis and stability. And she and Ronen are the joint authors of Sabotage, the Business of Finance. Anastasia, would you like to head off?
Thank you very much, Henry. Can you hear me now? I don't know if people, yes. Fantastic. First of all, thank you for organizing this fantastic platform. I've never seen so many people on Zoom. And I hope that it works. And mostly I thank people who have registered and went online on this glorious spring day amidst a global pandemic. The book is indeed called Sabotage, the Business of Finance. The American edition has a slightly different subtitle. They preferred a more loud message to the American market, but the more nuanced British way of the business of finance has an allusion to our key conceptual framework, which is Thorstein Veblen. But before we go into any academic concepts or theories, I think I want simply to say why we wrote the book. It's true that both of us have been working on the issues of political economy for a while. I mostly researched issues to do with the financial system, banks, currency markets, financial instability and shadow banking. Ronen has researched problems of sovereignty, offshore financial system, and how it shapes the way globalization. And so sometime...
You hear us? We don't hear Henry.
You're muted, Henry.
You're muted, Henry.
You have muted yourself.
Yes, sorry, you're now okay back. For one moment, I don't know if you touched something or it seemed to go for a bit.
No, we are far away from the screen, but
no,
if necessary, I'll be...
It's to do with internet, the quality of internet, I'm afraid.
Yeah, I think you're fine now. Keep going.
Okay. So we have joined forces because somebody, our literary agent, asked us, what is there you would like to tell us 10 years after the crisis? And we decided that there is one main issue that everybody has been asking now, not just in the immediate aftermath of 2009, but a decade onwards, is it's what is wrong with finance? Why is it so A, messed up, B, powerful, C, influential? And that probably was the key question that guided us into our journey. As we were answering it, and there are many kind of frameworks or levels at which we're looking at it, I specifically wanted to talk about why is finance any different from any other economic system or economic sector or industry, and why is it so powerful? So there are three main questions. They're very classically political economy questions, but they do guide us through the journey of the book. Sabotage is a concept from Thorstein Veblen. As I said earlier, it was invented, it was borrowed from the French language, from the word sabot, which means a wooden shoe, which workers used to protest against really being exploited or treated unfairly, to really undermine either the owners of their business, or later on companies or employees were sabotaging each other during the dawn of the American century in American capitalism. They were really sending physical armies to each other's warehouses or destroying railroads simply to ultimately control the market or to have that huge monopoly power. So we borrow that concept and Veblen's view of the industry and the very nature of business, and look through that particular prism to the evolution of the financial system, partly historically, but more specifically in the context of 20th and late 20th century. I myself am very interested in the phenomenon of financial innovation. I believe it's the fundamental process that defines and sets finance aside. It's what makes it very powerful. So one of the chapters is dedicated to the power of financial innovation. But answering or researching the issue of what is wrong with finance, we concluded that it's never really, despite the numerous books and memoirs and best-selling movies and or possibly even poems now and theater plays, the mess that finance has been creating for society and for us is never about individual rogue traders, very fat bankers, greedy owners, even shareholder values, or anybody in particular. In fact, the stories we use in our book probably highlight that the individuals that stand behind the innovation, particular process, usually were very guided by very simple, open-minded, and probably progressive ideas. It's the way these innovations were internalized by the system that eventually brought the system down, the financial institutions down, and ultimately cost society a lot of billions of dollars. So that is one part of our answer. It's not really about the individuals, it's not about individual behavior or something particularly human in finance. It's about a systemic trend. The systemic trend has to do with another problem that is much more fundamental and rarely discussed. And that is the problem that in finance, which is quite a competitive industry, just like in any other market, and just like you would learn from your economics textbooks when you open them on probably chapter 3 or 2, you will learn that in perfectly competitive markets, it's impossible to make super profits. It's impossible to get rich if you operate by market rules in that perfectly competitive system. If you play by the rules, if you do what the others are doing, and if you serve your customers. And that is probably the very simple idea that we develop further. And we suggest that finance, despite the concentration, despite the presence of huge financial institutions and banks, is in fact an open and competitive system. And without sabotage as a business tactic, you cannot make super profits. You cannot be very profitable as a banker, as a financier, as an institution, as a hedge fund, as a shadow bank, as an insurance company, as any other, as any element, as any entity that serves society in finance. So that's the very simple premise with which we operate. We research practices of sabotage at 3 levels. We trace how financial institutions sabotage their customers, how they sabotage the state, the government, and how they sabotage the market itself. So there are 3 levels, and the book is petitioned to tell this story in individual ways. All is based on, we didn't make anything up. It's all based on researchable material that has really happened. What probably is most depressing about our conclusions is that in some way it's an answer to the second question, why finance is so powerful, because we all are in it together. It's not a system that exists above us, outside of us, against us, or separately, really. Once we are born, and often before that, we are part of this financial system. We are being financialized. All our life experiences and human behaviors are already part of that financial system. We rely on this mechanism for current incomes, for future wealth, for predicting or planning our economic future, also our children. And that gives, or that endows our financial institutions with enormous structural power, which they in turn use often to sabotage the state in times of turbulence, in times of crisis. And I think Ronen will be talking more about this in the current context. It often goes through the whole concept of too big to fail, or too big to jail, or too big to be not important. But it's not the only way they do it. And probably the most important conclusion, although there are several, is that individually we cannot do anything about making the system better. The recipes towards a better financial or economic future, we kind of have. This is the economic program, the closest we have had ever as a capitalist society, is the economic program written in the 1930s, in the late 1930s, for post-Depression America as a Great New Deal. There was a deep crisis preceding that. There was a deep thinking involved in reconstituting the system and reforming it. And there were powerful resources dedicated to building those institutions and rules. The world has changed since then. A lot of those institutions were dismantled and the rules were either removed, forgotten, or bypassed. But this is the only set of principles we have as a capitalist society. But even with that prescription, individually we are powerless against a very large structural power of finance or any other big business. And one radical step to thinking more collectively about how to manage or how to navigate this system is to stop thinking about it as an industry of managing other people's money, and to start thinking about it as an industry of managing our common wealth. And that is not a very friendly message to people who now trust a very large and powerful wealth management industry. But really, it's impossible to get wealthy without using societal and political resources that depend on all of us working together. So with that, I finish and I pass over to, I don't know, Henry, I don't know how long I was.
Okay, no, that's very good. Mike, can I just ask you, firstly, just to give a couple of quick examples of sabotage, so we get a sort of an idea of what that amounts to, because yeah.
The book starts, it's any example of a customer being mistreated by financial institutions or a bank. The book starts with the story of Goldman Sachs traders who looted the Libyan Investment Authority of all its funds during the boom of early 2000s. Goldman Sachs bankers were giving speeches and selling points to their partners in Libya. One of the partners was in the middle of a desert with his camels. He still was sold complex financial securities, derivatives, that he was told are absolutely essential to his business in the middle of a desert with camels. The Libyans sued Goldman Sachs afterwards in the London court, but the judge acquitted the bank and concluded that there was nothing abnormal or unusual about the way this particular financial institution treated its clients in Libya. And indeed, there was absolutely nothing unusual about the way Goldman Sachs treated this particular client or any other client. It's a known fact. All facts are checkable. Another closer to home is dead souls at the RBS, Royal Bank of Scotland. One of the chapters is called the Dead Souls of RBS. It is, of course, a quote from Gogol, who was describing an actual person who was buying the lists of dead peasants in Russia at the time, in the late 19th century. But in 2007 at RBS, the lists of deceased customers were being used for personal bonuses of bankers inside the institution who would not file the death certificate on time, but would put the newly deceased client on the more expensive account, so that the bank or the manager will claim that now they have more assets to manage and they have more committed clients to be on their premium lists. We have a lot of examples. One of the one of the more modern one is a story of somebody called Sergei Mavrodi, who was essentially, he was a mathematician, but he constructed the greatest Ponzi pyramid ever globally in the 90s Russia, selling naive, newly opened Russians to capitalism tokens of something called investment fund. He bought huge advertising time on TV, and all Soviet screens or post-Soviet screens were full of a promise that if you buy the securities today for 5 rubles, you will get 25 rubles for them tomorrow if you sell them. It was the greatest Ponzi scheme ever constructed. He fleeced off millions of Russians at the time. He was put in jail not for fraud, which it was, but for tax evasion, because at the time Russia lacked the regulations that would diagnose it as fraud. But Mavrodi served his time in prison. He was let out. And some 20 years later, he launched Global. It was now a social credit network operating in cyberspace with new token money. It's cyber money. It's, how do you call it?
Crypto.
Cryptocurrency. The cryptocurrency is called the Mavro. There are 30 million customers to it worldwide, mostly in emerging markets, who are also being advised to buy the Mavros today and sell them tomorrow for huge price. And some of the returns are up to 400% per annum, if not more. Sergei Mavrodi unexpectedly died in Moscow 3 years ago, at which point Global announced to its clients that it stops all payments out due to the sudden death of the owner. There are some examples involving cyber currencies further on. Yeah.
Okay, that's great. No, that's really good. So I think that's given a really good summary for people to think about. What I'm going to do now is allocate you all randomly to breakout rooms to briefly chat. I'm going to give you 7 minutes, actually, because we're running a bit behind, to have an initial discussion. Then we'll come back and ask people to ask questions, make comments, which Anastasia and Ronen can respond to. Oh, yes, it looks like everyone is back. Right, now I'll just unmute Anastasia and Ronen. So I'm just gonna hopefully see, so I can see everyone in the participants. So I'd like if people could go into click on participants, and then they'll see the list, and against at the bottom, people are able to raise their hands electronically. So anyone would like to sort of make a start the ball rolling with a comment, can they electronically raise their hands? Then I'll unmute them to make the point, and then I'll bring in, I'll take 3, and then I'll ask Anastasia and Ronen to come back. Okay, I'm going to take Chris. Can you make your point? Chris Todd-Hunter.
Yes, hello. Karl wrote in his The Great Transformation, he maintained that finance, labor, and land, the 3 factors of production, were unsuitable, could not be produce effective self-regulating markets. You seem to start off with your book by saying that it is possible to have a self-regulating market for finance. I wonder if you could, the reason, just to outline the reason why Polanyi said that money is not suitable for a market, is that money is created and being created and being dissolved all the time. So it is a flow. So if you are in a position to do so, it's possible for you to create a large quantity of money in order to speculate on taking over a company, for example. And this distorts the market completely. So that was my question.
Okay, thanks, Chris. No one else has put their hand up so far, so I'll go straight back to Anastasia and Ronen.
If I can maybe begin by answering this question, Todd. Chris, I think in our book, we didn't really discuss this particular issue of Polanyi and his theories. Essentially, we took a much more kind of broad understanding, or both. We accepted the position that if, and of course it's a very big if there are in competitive markets, the market, if such a markets do exist, and we do understand they don't exist, and we do understand kind of the history of thought demonstrated, of course, the open free market is a fiction. But if such markets exist, we do accept the theory that such markets would be an efficient method of allocating resources. Okay, so we took that. We simply ignored the whole history and debates about whether such markets do exist in reality or not. But what we took it in a different direction from the discussion that Polanyi and other people have taken. We simply asked, okay, so let's assume what happened in efficient competitive markets. Well, our standard economists tell us that in such efficient markets, there's great difficulties in generating profits. Okay, so let's forget the issue about whether such markets exist or not. In theory, if these markets would take place, all right, and then it's very difficult to make profit. So then why do we see this profits? And the argument took us back. We took back to Veblen and Commons, the old institutional economics, who argued that in fact, one of the reasons why you never reach this position of a competitive free market is not simply because of systemic issues, political issues, but because the businessmen themselves will not allow the market to control them. They create large businesses in order to ensure that there won't be competitive market. They may talk in the name of competitive markets, and that's true not only in finance, but in any other sectors. They may profess to support free competitive market, but in reality, it's free competitive market for somebody else, never to ourselves, okay? Because if my business will be subject to the discipline of the market, I'm not going to make a lot of money. So it is.
Can I, Ronen?
Yes.
Because one of the things that came up in the group I was in was from people in the finance industry said, well, is it that competitive always? And presumably all the big, I mean, it's very difficult to become a bank. The regulatory barriers, it takes years to become a bank. Obviously, there are huge brands in finance, which seem to control a lot. I mean, and obviously, maybe they manipulate the regulation, but that's what everyone does. All businesses try to manipulate the regulation so they're better at it. And more regulation is probably good for incumbents because they have the capacity to actually manage the regulation better. And it keeps competition out. So, how do you say that regulation, that the finance sector is particularly competitive?
Actually, in a sense, you are rehashing the same argument about sabotage. Regulation, in a conventional view, business do not like regulation. They are looking for a deregulated environment and so on and so forth. The reality is, of course, that in a competitive market, business, particularly big businesses, seems to be better, or they believe they are better in manipulating regulation and taking advantage of different regulatory environments to their advantage. In other words, the regulatory environment itself can be sabotage, can be a technique for sabotaging other smaller businesses. So that's the same argument. The argument is that you're making about that business is good at taking advantage of regulation, advantage vis-a-vis who? Vis-a-vis other businesses who are not as good as taking advantage of regulation. Regulation itself become one of the techniques of sabotage, which is described in this book.
But then, you know, since in all sectors, bigger business benefits from regulation, that sort of somewhat removes the particularity of the finance sector.
Absolutely. That's why we called it, and I think Anastasia hinted at the beginning, between the kind of American subtitle and the British subtitle. The subtitled book is Sabotage, the Business of Finance, by which we want to say, don't think of finance as something so special. It's a business. It's operating as a business.
It's the art of buying and selling.
It's the art of buying and selling.
It doesn't matter what you buy and sell.
All right. So in that sense, we don't think that financiers are worse than, say, your supermarkets, who will use any technique in a book in order to effectively sabotage their own clients in one form or another, or any other sector. All sector finance, we should think of finance as a business, and businesses, all businesses are subject to the problem that in a competitive markets, they are unlikely to make a lot of money. So the fundamental premise is businesses really have to, or not have to, but successful businesses are very good at sabotaging somebody, either their clients, either the competitors, or the society as a whole.
Okay, Robin, come on in.
Hello. Well, the discussion we were having in our breakout group sort of links on to that question, or rather to the reply, because isn't finance separate? Because they can just sell us an idea. I mean, for example, if you buy a loaf of bread, you can pretty quickly know whether you've got a decent loaf of bread or not. Whereas the load of people who were buying the whatever it was that Anastasia didn't know what they were buying. They were buying an idea, and that makes it particularly liable for finance to just sell us an idea, whereas most businesses, or many businesses, couldn't get away with it.
So it's easier to sabotage in finance. I'm just going to ask Molly as well to make her point, and then we'll get Anastasia and Ronen back, and then we'll move on to the application to the COVID pandemic situation. Molly.
Yeah. You mentioned in the book about the efficient market theory, in which a market in which prices are fully reflect available information is efficient. And I wondered how you would apply this to the current situation that the US Federal Reserve has set up special purpose vehicles to purchase junk bonds now, exchange traded funds with junk bonds, and they're purchasing mortgage-backed securities, etc. I wondered what you thought about that in relation to sabotage and price discovery now with the corporate bonds.
Well, your question takes us, I think, quite neatly into the next section. So maybe, Ronen, if you pocket that question from Molly and take Robin's question, and then we'll move on to the COVID, and Ronen, you can come back and pick up Molly's point then in that sort of broader context. Thanks, Molly.
Okay, so I'll start, and maybe Anastasia will come to that.
But Robin first. But Robin, the point of the ideas, yes.
Yes, the point, if I understand correctly, is that in the case of finance, basically finance is selling an ideas, it's easier to sabotage markets, public, and so on and so forth. Now, we gave an interesting case of another sabotaging techniques in the cosmetic industry. And before Anastasia will go and describe the case, let me just remind you that rule number one in the cosmetic industry, which I think is 40 billion, no, it's 400 billion. It's a huge 400 billion. Rule number one in cosmetic industry is that the product does nothing, okay? Because if the product does something, it becomes a medical issue. So whatever is being sold in the cosmetic industry they have to prove that their product, they can say, you know, it makes you younger, healthier, whatever. They have to prove that the product does nothing. All right?
Otherwise, it becomes a drug and it's subject to different regulations.
And now we have a business of 400 billion a year or more, which basically has on one hand to prove that they do nothing, and at the same time demonstrate they are competitive. And Anastasia will tell a bit more about it. If you want to tell about.
Yeah, so it's also almost a textbook example. And I don't know how often you walk around drugstores or department stores looking for new makeup or skincare products. But usually you would find that there are several stalls next to each other. It's L'Oreal, Maybelline, and can be She, can be Helena Rubinstein if you're more into an up marketplace. Maybe Giorgio Armani Beauty. Of course, there is a Lancome, and lots of other things. When you do a corporate, and they all do, they compete with each other on price. You know, they have different colors or brands, or of course they have fantastic lists of very unique ingredients, and each ingredient that is key to that particular price will be under copyright mark if you read carefully the box. When you do the corporate analysis of the industry, you will know that all of these brands are in fact owned by L'Oreal. L'Oreal itself, Bourjois, Maybelline, Helena Rubinstein, Giorgio Armani Beauty, it's all L'Oreal. It's a huge, you know, it's a giant monopoly over really our choice. And of course, Lancome as well. So the economic answer to this, if you want, paradox is that, well, because it's so big, it can more efficiently serve our needs as customers because they share research costs, logistical costs, and very kind of capital intensive resources that are required to produce this wonderful products and skincare and makeup and perfume and things that make us happy and beautiful. Also an idea, in fact. A more cynical theory coming from Veblen is, well, it's not really so much about the shared research costs. It's about sabotaging and cornering and controlling the share of the market, which for L'Oreal is absolutely huge. They do control the global industry alone.
But how does this relate to Robin's point that there is?
Well, it's an idea.
Okay. Can I answer Robin's point a bit more, if you want? I do agree that there is. That's usually an example. I use rotten apples example with my students and supermarket vis-a-vis a mortgage. But there is a distinct quality to finance, and it's a trade in promises. It's not really an idea. An idea, you can buy pieces of art as an idea. They have absolutely no intrinsic value, but all that is valuable about it is simply an image or an idea. In finance, you trade in promises, and every financial transaction or a product is really that promise of the future. And that is why it's so powerful. And that is why the industry can sabotage it as a systemic, sabotage us and the state as a systemic environment. Because it's more difficult for us to react. It is about anticipating the future and programming our actions for the future. But also because it's so important. It's the only industry that ties us today to us tomorrow.
But just taking that, I mean,
a loaf of bread doesn't tie us. Your loaf of bread is very much a point in time. It's today, it's perishable, and you can eat it or you can throw it.
But I mean, I know, taking the point that finance sells promises, I mean, they do try, and you know, they produce lots of charts showing that they're beating the benchmark and so forth. They do make some effort to demonstrate that they're sort of achieving the promise in terms of their stats and so forth, don't they?
I don't think, well, the charts, you're talking about something which is quite common in business. You try to demonstrate that you beat market average, okay?
Yeah.
In most businesses, basically, well, in the standard approach, standard theory, we believe that businesses are about maximizing profit, but of course, nobody knows what is maximizing profit. So what has replaced this notion in practice of maximizing profit is the notion of beating the average in my sector, right? So that's effectively what's going on in finance as well. They'll show you by charts that we are beating the average in our sectors in whatever market we are. And hence, invest in us or let us manage your money. But coming back to the question, so I gave the example of cosmetics to say that a lot of sectors in business, a lot of business sectors are effectively selling you ideas. But Anastasia is correct. It's not simply about the idea. The uniqueness of finance is this kind of bridge between the present and the future. Value of wealth is based on future, anticipated future earning discounted against current interests. We are really dealing with what is the future is going to be valued. And that gives you a very powerful technique of sabotaging people, of selling them basically certain futures.
Because I suppose all industries sell an idea. Cars are an idea. Security is I suppose that's common, but it's the link to the future that's different. Okay, can we now move to the question of, in this new context of the pandemic and all the dramatic, unprecedented economic policies that different countries have put in place, how's that going to play out with the finance sector, who have obviously lost, they've crashed. There's been a huge crash in values and so forth, and dramatic, so seeming losses going on.
So I think this is a tough question for us, both of us, and we try to think about it quite carefully. And I think what our study could be helpful is not necessarily in anticipating exactly what's going to happen, but more anticipating a type of behavior that at the moment doesn't seem to be taken on board. And I'll come back to kind of something that we heard about through the grapevine. We talked to a lot of people, and there was a story about Lehman Brothers. That just before Lehman Brothers collapsed, there was in one of the last meetings of Lehman Brothers discussion of some deal, and the question arose, and the lawyer apparently at the board meeting said, "Hey, don't we have a conflict of interest in this matter?" And the chair said, "No conflict, no interest." This is in a sense captured that particular mode of thinking, way of behaving toward issues. And that's what we think is the way we would recommend to look at what's going on now with regard to the COVID crisis, okay? So essentially, we think of bankers in a sense as businessmen and women, okay? The COVID crisis, I mean, it's a huge catastrophe. We're all sitting at home now at the moment. I think we're all very concerned. We are all worried. But from a business perspective, it's an opportunity. Management of those big banks probably think of this particular crisis as a huge opportunity. And it's a huge opportunity because on the one hand, the state is in a very vulnerable position, all states. They need the banks to disperse funds on the one hand. At the same time, this is not a time for strong monitoring. There's no strong monitoring going on. There's no inability. Everything is so fast. So this is a business opportunity. And that's, I think, the basic thing, the way I would think about it. It's an opportunity to achieve 2 or 3 things. First of all, it's a huge opportunities for these banking industries to deal with all sorts of problems that build up in the last few years that developed internal to this particular banking due to mistakes, other forms of sabotage, and so on and so forth. They have built up a lot of problems in many of them. Now they've got almost a carte blanche. First of all, what they'll do with these funds that they are in charge of dispersing to the public, but they do it in different ways, different countries. I believe, number one, we'll find out not sooner or later, and I think the scandals we begin to hear the scandals in a year or 2 or 3, that in fact, the first thing they've done, they resolve their own internal problems that they have generated in the last few years. This will be their number one. Number two, I think management will now think about how to beat their competitors, okay? They'll be less concerned, they're not at the NHS, how to save lives. It's about how to beat the competitors. how this particular moment is an opportunity to get ahead of my competitor, what my competitor might do to get ahead of me. So this is the way we would think about the behavior of banking industries and other financial institutions during this crisis. What we don't see, or we don't hear at all in the discussion going today, is about that. We don't hear about the possibilities that, in fact, all these opportunities, that this particular crisis will be taken as an opportunity. We know about, of course, the short sellers and so on and so forth, you know, they're being vilified, but we don't get a sense that the issue of sabotage is so central in the thinking about what is going to happen in finance. So to summarize, I mean, that's my perspective. Maybe Anastasia, you want to add to it. It's very difficult for me to anticipate at the moment how precisely they're going to behave. What we have learned by studying this particular industry, talking to people and so on and so forth, is how innovative they are. But I think that probably this particular crisis can generate another wonderful book called Sabotage. And in 2, 3, 4, 5 years, we will begin to learn how this crisis was used by the industry as an opportunity to sabotage each other, sabotage the state, and probably the.
Can I just, before going to Anastasia, just one question. Sorry. I don't know if sorry. One question. One of the things that happened with the Chancellor's package, I understand, was that within a few days, he had to remove a lot of the controls because the money just wasn't flowing. And there was a lot of negative press on the Treasury with too tightly controlling. It hadn't realized that the priority had to be to get the money out and so forth. Is that a sign? Was that a clever move by the banks, do you think? Or was it real that the Treasury had got it wrong?
It could be a bit of both. The Treasury got it wrong massively during the last crisis. They were almost the last ones to arrive on the scene. When Northern Rock started to go down, it took them more than a month to actually process the idea that a bank can be a systemic threat. They had been warned in August. It was in September that they actually acted. So between the overall financial regulators, the UK Treasury is usually not the most dynamic or effective as a regulator manager. So that's to speak to that side of the problem. On the other hand, removal of regulations or I can imagine the banks doing a group talk and voicing their strategy. I can also imagine somebody from maybe inside the regulatory community saying, look, we did trust the banks last time to pass on the credit from the state to borrowers, and it was in the aftermath of 2009. They did not do it. Instead, they bought securities and created an asset bubble that made a whole lot of people richer, but didn't do anything to the other side, the majority of the people who actually became poorer and were told that they have to pay back somebody else's debt. So I would assume that maybe this could be a theoretical attempt to bypass the banks and to move the money quicker to the actual business community. But I have to say, I don't have enough of inside information.
So we have statistics, don't we, of how much money is going in to the banks and how much money is going out. And apparently it's 1.4%. There's hardly anything actually got through the system.
Right.
Surprise, surprise.
Correct.
Surprise, surprise.
In earlier crises, what banks did, not necessarily British banks, but it's a habit in the industry. You use a good never let a good crisis go to waste. So you can write off your bad junk, you can write off your bad debts, you can hide something, you can create a balance sheet. No, there are innovative ways to solve, as Ronen said, your internal problem that would be a priority for you as an institution.
So you take your losses while all the losses, everyone else is losing it.
And then you run to the state, exactly. And then you run to the Treasury or whoever it is that is giving you the state aid and say, look, no, this is what I have. and this is all needs to be now board chaired, and please monetize us. We are systemically important. Without you, you don't have this regional support or whatever.
Everyone was talking in the run-up, over the last few years about zombie companies, which I understood to be ones that were heavily indebted, but were still surviving due to the very, very low interest rates. Is that right? And how's that going to play out? Because presumably these zombie companies will now maybe not be able to get their debt renewed, will not be able to access future loans because of the sudden increasing risk out there, or not? Is that misunderstanding?
Yes, I actually...
I'm not familiar with the terminology of zombie companies, but clearly what had happened during, in low interest rates environment of such a long time, that many companies have went into over leverage, went into huge debt. Partly they do so for tax purposes, okay? It's very important for businesses to not to make money. I know it sounds counterintuitive, but generally speaking, businesses that are making money are targeted by others. So you have to kind of show yourself losses, and taking huge loans and huge debts is one way of ensuring that you're constantly in losses. So I'm not familiar with the term zombie companies. Look, I think the question you're asking goes deeper and goes beyond what kind of we discuss in the particular book or the effect of it. It goes into the kind of financial economic landscape after the crisis. Now, I think this is a very deep crisis, okay? I think the world will be completely changed. The economic landscape will be not totally, but completely changed in 2 months' time, in a sense that a lot of people lost their jobs. Many companies now, I don't think, will hire the same amount of people that they lost. They will discover, that some people that they maintain, maybe they didn't need them. Secondly, they'll be very concerned about market conditions, generally speaking, and hence, I think that we are going into a world of structural unemployment of 6, 7, 8%. At the end, in 2-3 months for a prolonged period. And in that particular environment, it could be that companies that are over leveraged will be in great difficulties. Yes, but that's kind of macroeconomics. That's a different format.
And the banks presumably are holding quite a lot of this debt that will go bad.
Yeah, they will monetize the debt by high-powered liquidity from the state. Anything that could be exchanged for high-powered money will be. In fact, it's almost the phase 2 of what happened in 2009. Remember, there were Lord Ada Turner was talking about helicopter money and high-powered liquidity, how it all needs to be monetized by higher quality money. This is it will need to be done now.
But presumably, so are you saying actually at the moment we probably don't know who is holding the risks? Like we didn't know, no one knew who was holding the risks of all this over-leveraged debt, which is going to collapse. And this will take some time to unravel.
Yes.
I don't think it will collapse because the governments now promise to hold it.
Consolidation and statization, if you want, a very clever term, of this particular debt. It will be monetized and liquefied. It will be again converted into higher power.
But are they going? Is a government's going to underwrite all the private sector debt that's in existence prior to the crisis?
They will be asked to. They will be asked to.
At the moment, they promise they'll do. I mean, if you are a banker, fantastic. Okay, all right. I lent huge amount of money. I really, I shouldn't have lended so much. I over-leveraged, so on and so forth. But the government, at the moment, in the United States, Britain, so on and so forth, are saying, we will cover this debt. Well,
moreover, banks will also use their structural position of power to say, you want us to lend to recovery? You want us to continue to keep the credit flow going? Remove regulation, give us more conditional make it happen, because they will be prepared to loan. It doesn't take them anything to create a loan electronically. They're not dependent on anything. They create money literally out of nothing, but they will be requesting something.
So all the private debt goes onto the public balance sheet. Anyway, let's
as it did before.
Let us have a quick breakout, this time 5 minutes, and then we'll come back for a plenary to take some comments and further discussion. Again, I'm going to do automatic breakout groups. I'm going to recreate them so so people go with different people. And I'm going to do just 5 minutes this time and go from there. See you in 5 minutes. Okay, brilliant. Welcome back. And now we've just, we've got about 10 minutes or so before we end. Can I have some electronic hands up? Go to participants and hit, yes, we've got Chris. I'm going to unmute you, Chris.
Well, thank you. I'm sorry, I'm hogging the thing. There was no mention at all of the impending massive deflation, which will result from, say, 30% unemployment, a huge deflation. The government spending is certainly not going to cover that.
Okay, thanks. I'm just going to bring in Andrew Purvis now.
Hi. Thank you for the talk. I found it very interesting. I'd certainly like to read more. But could you give us a brief outline of how the finance market might be reformed to avoid this ability to sabotage others?
Thank you, Andrew. So shall we start with, yes, deflation, the huge deflation, potentially due to high unemployment. Is that?
That is the most probably important question, because deflation is one of the greatest dangers in political economy and not very well understood. The last time deflation hit a large economy and the international system was, of course, the 1930s, after which there were two institutional solutions to the problem of deflation. And I will cite Minsky, Hyman Minsky, who is my kind of intellectual, I won't say hero, but a light in navigating the financial system. He was always, all his life, he had been interested in one question: can Great Depression, can it happen again in a more advanced financialized capitalism? He lived in the 1980s, he was writing in the late 70s, 1980s. And he concluded very skeptically, he was a skeptic, that yes, Great Depression can happen again in a very advanced financial capitalism of US economy. But he said there are two institutions who can help avoid the repetition of the 1930s, is the big bank and the big government. And you're absolutely right, Chris, to say that the big bank that is going to be printing essentially very high-powered liquidity is not going to solve the problem of deflation. But the big government should. And big government assumes a return to very strategic involvement of the state in planning, coordinating, partaking in the economy, in the public sector, and creating a lot of non-financial but political economic pillars for aggregate demand management. Something that was not done in 2009, and partly, which is why we're in this uncertainty today. So
you were saying that we want fiscal policy, spending rather than monetary policy?
Massively, yeah. Not rather, together. It cannot work on one without the other, doesn't work, but it's the only way into something that would approximate stability.
It's our only chance.
So is that like, that potentially a Green New Deal?
If the minds together, if they realize that, you see, I was writing, I'm not sure where I wrote it, either in this book or in the book before, I wrote that, of course, 2007, 2009 was a huge crisis, but it's simply in longer perspective, and especially considering how short the memory in finance is, it became very mundane. It simply wasn't big enough to generate the reform that was required. And now I know exactly what I meant. This is the big crisis.
This is the big crisis.
That was supposed to happen.
One particularity of this crisis, which I don't know if it has any precursors, but is this payment for furloughed workers and the self-employed. And obviously that's been seen or framed as a temporary measure. But in a deep recession, I wonder whether governments will actually be able to remove it. And this will create a very strange situation, won't it? Because that's effectively a fiscal impetus. And you'll have sort of two classes of unemployed, effectively, those who are furloughed and were self-employed who will get substantial benefits. And then another set of people who will be on, in the UK, obviously, the universal benefit and will get hardly any. And how do you think that's going to play out?
Some people will get very rich and some people will not. Well, probably they will become poor.
I think the scenario, probably the scenario that you're raising, it seems to me to be correct. Okay, I have no idea how it's going to play out politically, socially. There was a talk already before the crisis that at some point, effectively, people will have to be paid not to work. There was, we reached a particular position globally in terms of climate change, in terms of production, so on and so forth, in terms of increasing productivity. In fact, we need to move to a different system in which people will have to be paid, simply not to work. It could accelerate this process. It could be this particular crisis, according to this scenario, could be the harbinger of really fundamental structural change. And I think I don't know if it's very likely, but it's not unlikely. But the implication of those, in 2007-8, I guess many of the people who are listening to this discussion were like us, glued to television and trying to understand what's going on around 2007-8. One thing I never predicted was Trump, okay, 10 years down the line, or people like that. I just couldn't predict. And that really shows, at least in my case, the limitation of ability to really predict and anticipate the effect of such deep crises. How do they fan out over time? It's very difficult to anticipate. You can anticipate one or two steps maybe in the next few months, but beyond that, I think we cannot really.
Okay. Now, I haven't picked up, Andrew was asking, how do we solve all this sort of thing, or what governments can do? I suppose here we have a case study in which governments seem to be in an activist controlling, or trying to be activist controlling of the situation. Obviously, they've got a crisis moving at huge pace, so that limits their potential. I mean, what advice would you give to the UK government at this point? I'm sure you've been asked, but maybe you could tell us what you said to Mr. Johnson.
Okay, I think there are two questions here. I think what Andrew is asking is really about what sort of regulation or systemic regulation can be dealt with the issue of sabotage. Okay, so this is one set of questions. And there's a separate one about what would we recommend Johnson or his colleagues what to do. But the first one, and I respond to Andrew first, this is a tough one for us. And in this book, basically, again, we suggested more about a way of thinking. We suggest that we should incorporate this notion that a financial system, an unregulated system, basically encourages sabotage. We should build it factor it into our thinking about regulation. This was the case of the 1930s. So most of those regulations of the 1930s in fact, were aimed to deal, they didn't call it sabotage. They used other terminologies. But effectively, the assumption was that the cause of the crisis of 1929, or the assumption at least of congressional reports in the United States, was to do with unregulated financial system, people are taking advantage of the weak or the less informed, essentially sabotaging. And so the regulation that we introduced in the 1930s were really aimed to block or to try to limit the amount of sabotaging available in the financial system. And that's, we are not saying, we're not asking for a return to the 1930s regulations, which incidentally, most of them are still with us. People talk about deregulations. That's not entirely true. Many of those regulations still exists. That's just being sidestepped through a global financial system or offshore financial system. We're not asking for the same regulation, but we are asking for the same mentality. Think of a financial system or deregulated financial system. Think about the problem of potential sabotage. By the way, in the same way that people, Henry, yourself and others already began to think very actively about the crisis today, how a saboteur will think about the crisis. And, you know, many of the scenarios that were raised here in few minutes seem to be, to me, quite likely. So that's the one answer.
Yeah, maybe on this particular view, and much more prosaically, I would say do not trust, do not defer to business, do not trust business. Markets are quite clever mechanisms for allocating the resources, but there is a distinction. We're making a distinction between the market and the business. Normally in political discourse, we're told from TV screens by our great politicians that it's really the same. If you have the market, it's, you know, the businesses make these markets. No, the story of sabotage is really about the nature of business. We just took finance as one example, but it's going on in all industries of the economy. So I think a very British, if you want, cultural trend of delegating or trusting or creating a very friendly environment for others to sort it out probably will be required to be rethought with a more proactive and competent engagement with the actual process of market making.
It's a sort of irony that banking, which was meant to be built on trust, is actually totally untrustworthy. I mean, other people, John Kay and others, I think, have said, is we want to make banking dull again.
No conflict, no interest.
Exactly.
You remember?
The dull time of banking wasn't also, you know, I also have an issue with this nostalgic view of the 1950s as, you know, let's all go back. We were much younger and prettier, and, you know, we can relive it. We can relive the movie now if we just go back to that time. I think it's quite naive. It was an uneven system. It was a system where, you know, it was difficult to get to a credit. You know, there were restrictions based on social factors. So it's quite primitive to think that we can reconstruct that particular reality. But it's also, there is a concept of revolving door between financiers and US really regulators and policymakers. And of course, we are used to the very negative story of that revolving door, Goldman Sachs around Treasury, people controlling a particular very important segment of regulations. And those, of course, are ex-industry. This is somebody who had worked in Goldman or somewhere else before. But the other side of that coin is that everybody around the world, if you are a banker, you're very scared of US regulators chasing you. That's the only power that can work over you. You're not, but you're never bothered if a British regulator suddenly starts asking some very unfriendly questions about a particular transaction you conducted in international markets. Because you know the Brits would never touch you. It's too expensive, they're not competent, they're not dynamic. You know, it's all very, very, very British. But if Americans are starting to ask those questions, then you're in trouble. And maybe this, well, it's now anecdotal. I just have a few friends who, back in 2008, they were really selling securitized debt. They were the industry players. There were people either creating the products or selling them. And at the time, British regulators were hiring the experts from the industry to work for the regulators, to have some competency in that particular area, not to be a, you know, civil servant with an education with textbooks written in the 1960s, but to actually have on-the-ground competence. And I would probably advise now to think a bit more proactively how you can engage with that type of human capital, rebuilding the economy. It's not just about the layer of, you know, civil servants and and delegating it to the banks and then the business. Probably another social layer would need to be recreated.
But the question, Henry, you also asked question, what will we advise Johnson? And,
oh yes, okay, that would be a good place to end.
The government is not doing well. Of course, I would say announced delay to Brexit. That will be that will be one glimmer of hope to the markets. Okay, because at the moment Britain is really facing a double whammy: Brexit and the coronavirus, and the coronavirus is much deeper. But I think my sense is we are talking about a government that is not performing well at all during the crisis. Okay, not well organized, not performing well, not a good situation at the moment.
Well, yes, I'm not quite sure. Yeah, well, I suppose that's, I think probably no one would disagree with that. But I think you've also suggested some light. If we can, the government can actually turn around and inject dynamism into the economy.
We didn't say
help.
It would be this government who does it.
Okay, a government.
I didn't specify.
Okay. Right. Well, I think we've come to the end, 8:30. I think that has been really fascinating. I think trying to get our heads around what is happening at the moment and giving that sort of introduction to help us sort of think it through has been absolutely fantastic. I think we're all struggling to try and make sense and imagine what the future will be. And I suppose some people are putting lots of bets financially on that as well. Luckily not me. But so thank you very much. And I don't know how, actually one thing we can't do in this situation is everyone sort of, well, we could have a wave of thanks from people. And thank you very much for everyone joining us. And do click on and join our mailing list so you can hear about future events and get our regular weekly newsletters to keep you in touch with what is really going on. Because
thank you very much, Henry, for dedicating.
Thank you very much, Anastasia. Thank you very much, Ronen, and thank you everyone else. Until we meet again.